Hi, I am Lesley Barlow. I'm sitting here with Roger Tillis, and Roger and I are going to talk to you about 5 mortgage myths, and hopefully we'll be able to save some people some money, and
Sure.
maybe have some others think about qualifying a little bit early. So Roger has been in the mortgage and finance business for around 30 years.
Long time. I started when I was 2. So.
And anyway, Roger is a mortgage advisor with Watson Mortgage. And the one thing that I just love about Roger is reading his testimonials from customers. You've got some great testimonials.
Thank you.
And it's very humbling, isn't it, when you get such positive feedback from somebody who's placed their faith and trust in you.
Sure. I mean, anytime you get good feedback, I mean, they say you learn from mistakes and whatnot, and that's great, but I think feedback in general is good for all of us to grow. But I gotta say, it does feel good when you get to the end and things are done and you can look back and you get these comments and the feedback from the client who is happy.
Yes.
And they enjoyed going through it, or they felt comfortable and confident, that they were being led down the right path.
Right.
And anytime you can get to that end point and you see a happy client, I mean, that's what makes us happy. So that's what we're in it for. So yeah.
And we're going to try to make some of you happy right now, save you some money. And the one thing that, as an agent, I talk to my customers about is always getting, when they're financing, always getting more than one quote.
Mm-hmm.
And that's the first myth we're going to bust, is that you only need one quote.
Yeah, you're buying something. You're buying, in most cases, probably the biggest investment that you've put your finances into is your home, and it's no different than anything else. I've seen people go out and shop around for a TV and go to 5 different stores and websites and whatever, to make sure the quality is good and everything is good. Well, with a house, it's bloody well no different. I mean, you better be getting the different quotes, and not so much just about rate. You can go online and you can shop rates all you want. You see who's doing what. The problem there is that you're getting basic vanilla information. Every loan, every client, everybody is individualized. Everything is different on how this process works. So you need to talk to the banks, the lenders. You need to research. You need to find out the cost. You need to find out the rates. You need to find out, can they get you to the closing table in time? Everybody says that they can. You better do your research and find out what's their record on really getting people there on time. To your point, saving money, you don't want to find out that your lender is causing you to extend your closing date, and then you find out that it throws your finances out of whack. So it is so important, and it doesn't take much time. You can make a few phone calls in an afternoon and get 3 or 4 quotes, talk to 3 or 4 people, see who you're comfortable with.
And one that brings me to something else that I hear from customers, and that is that they don't want to shop around because they're worried that it's going to hurt their credit. So our number 2 myth that we're going to bust is shopping around will hurt my credit.
Yeah, it won't. I'll just be very clear, it will not. Here's the thing. If you go and you're going to buy a house and you're talking to these different lenders, and maybe you want to get pre-qualified with several lenders simply because they need that information to drill down to know exactly what kind of rate you can get. They need to pull your credit. Credit scores are the big driving factor on where on the rate spectrum you will fall, good rate, bad rate, etc. So you go in and get your credit pulled several times by several banks. It might affect your credit a couple points. And we've always said, as long as within a month, these banks for mortgage purposes are pulling your credit, it won't affect your credit. You might see your a point or 2, I have anyway, in the credit scores, but it's not a hard pull where all of a sudden you're going to be dropping 20, 30, 40 points. It just isn't. They're not all hard pull individually. Now, if you went and got a Visa card and bought a car and had your bank pull, and then you also bought something on Amazon and you had to have your credit pulled, well, those are all separate entities pulling credit. Yes, that can affect your credit, but shopping around with different banks, not at all. You're in good shape on that.
So the number 3 myth that we're going to move on to is that you only need to look at the interest rate when you're getting those mortgages. And you spoke a little bit about this when we were busting the first myth.
Right. Interest rate is one part of it. Now, let's be honest. I mean, when we're talking about, calculating a payment and we have the same loan amount, obviously, especially if you're looking at different lenders and you have your rate, you know what you're getting locked in at and you know what your rate's going to be. It's pretty simple. You calculate, you see where the difference is. But you do want to look a little bit farther out. You want to make sure that, you're comparing apples to apples, not just rate, but the term. Make sure the term's right. Make sure that the, no prepayment penalties, nothing like that. You got to look at the cost too, the total cost. Right. And man, I tell you, in this day and age, it's so competitive. You hear a lot about, we'll pay your closing costs and things like that. You got to be careful and find out where these costs are coming from. Because I'm telling you, banks are in the business to make money. Builders are in the business to make money. They're not philanthropists. They're not just giving it away on a whim. So you want to make sure that this overall cost, that you're tracking it, and your advisor should be doing this for you, should be able to break it down and see truly what is the overall expense. And again, and I kind of came to the point before also, timeliness. Are you going to get to the closing table the way that they promised? So these are all things that you want to take into consideration. But yes, simple math. Yes, of course, the interest rate is important, but you got to look at everything else as well.
Myth number 4, the no closing cost mortgage. And again, you just touched on that.
Oh boy, yeah. I tell you, the marketing geniuses out there, they're not. It's not that they're being, mistrusting, or they're not trying to mislead anybody. What they're doing is they're telling you part of the truth, and that's marketing. And it's genius. It's wonderful. It's the focus on the consumer, what the consumer is thinking about. I mean, you're thinking, what do you think of when you hear no closing cost? Free money.
Right.
Free. Everybody loves free.
But as you said, they're not writing a charity.
Yeah, exactly. Here's the thing. All lenders, for the most part, have the ability to create a credit that will absorb the closing costs for you. Without getting into major details, essentially it comes down to the interest rate, back at the interest rate. When you are getting your interest rate from a bank, there is, think of it as a menu. And you are getting a certain interest rate and you hope for free. In other words, no points, no price tag associated with getting that rate. Well, you can pay points to drive your rate down and get a better interest rate. But on the flip side of that, you can take a little bit higher rate, and that not only is free and you're not paying for it, but we, the lender, are actually paying you in a credit. So you can take a little bit higher rate and get a big enough credit to help absorb those closing costs. So that's something that any lender can do.
And can you roll in closing costs into the mortgage?
You cannot, not on a purchase. Now on a refinance, you certainly can, but not on a purchase. Simply put, the closing costs have to be paid. And one way or another, again, the banks are not just going to pay them for you. You do hear some of the banks talk about, we'll pay in real small print up to $5,000. And you're thinking, oh, what do you hear? $5,000 of closing costs are being paid. And that up to that $5,000 could end up being maybe $1,200 because they get into your loan and they start seeing risk factors. And also you have to be careful for some of these deals. There's a limitation on it. So if you happen to pay off your mortgage or sell a house or something takes place within 3 to 5 years, all of a sudden they're charging back all of that money. There's a lot of things that you have to look at. But just understand, these banks are not giving this money away. They're not in the business to do so.
You're paying for it in some way.
Yeah, I mean, they're not lying to you. They're just not telling you where that money is coming from. So, and that goes for builders too. Builders can create credits, but they get it back in other places. It's our job as advisors to be able to break that down and find out truly who's paying for it. And it's okay, as a buyer, you may need those closing costs to be taken care of for you because you don't have enough money in the bank. Just know that it's a trade-off. You're taking a little bit higher rate, the cost of doing business, to have them pay the closing costs for you. That's another way of putting it. And it's fine. We do it a lot, to create that credit to help the clientele. Just be aware that it's not a giveaway. It just simply isn't.
Myth number 5 that we're going to bust is that you need 20% down. And I mean, our parents drilled that into us.
Oh, sure.
20% down, you need to save 20%, but that's not the case anymore, is it?
It's not. If you want to get away from mortgage insurance, so this is something that we talked about in a previous episode where we were talking about how mortgage insurance comes in. 20% is kind of that threshold of safety for investors. Fannie Mae, Freddie Mac, FHA, VA, they all look at risk. And they figure that if you, the client, are putting down at least 20%, your skin in the game, so to speak, that, safe bet, it's not as risky. That's, again, their threshold where they feel like, okay, this is good. This is a good loan. This is going to make us feel good. So we don't need to bring in mortgage insurance into play. And so you as the client, mortgage insurance, if you can get away without having to pay it, hot dog. Because that does nothing for you. It is all about protecting the investor and the lenders. So if you can get away from paying mortgage insurance, which could be in excess of $200 a month, then yes, if you've got the money in the bank and you can afford to pay that 20% down, by all means, do it. Now, what's the flip side? Maybe I'm a first-time home buyer, I'm a young couple, we're starting out, we haven't saved up that much money. Well, there are ways to be able to get into a house. You can put 3% down. The Fannie Mae has first-time home buyer programs as little as 3% down. You can put, for your conventional loans, 5% minimum down. Again, what's the exchange? What's the trade for being able to do business that way, to offset that risk? You're going to pay mortgage insurance. You might also pay a little bit higher interest rate. Other than your credit scores, one of the things that lenders look at too is how much are we on the hook for? How much are we financing and trying to approve you for? The higher amount, the higher the risk. So what is that going to do? Maybe offset by driving that interest rate up a little bit. So again, yes, you can get into a house for minimal amounts, but you will be paying for it somewhere along the line. And then you have VA loans.
Right. VA
loans, you can put 0 down. Some of the USDA loans, you can put 0 down. Again, same thing though. Now VA, you won't have mortgage insurance because it is VA. VA doesn't charge the mortgage insurance. 0% down, hot dog. You still got to qualify though. So if you have a $300,000 mortgage and we're calculating the payment, you obviously need to be able to still qualify debt versus income for that. Be prepared. You're going to have a little bit higher payment, obviously, because you're financing more. But anytime, though, you can put money down. A lot of people look at it as almost like, I got to pay this money. Well, it's not a fee or a charge. You're taking one asset and you're putting it into another long-term asset that you hope, whenever you sell that, you get that money back and then some. So there are certainly many, many options to be able to buy a house. And of course, you have some of these first-time home buyer down payment assistance programs where they come in and they'll give you blocks of money if you qualify for it, and your advisor can walk you through on whether or not you qualify for that. Some are like $7,500. We just had one that just the funds dried up on it for $15,000, and it was forgivable. 20% every year it was forgiven. So after you got to 5 years, that $15,000 was truly free money. So there's a way to get monies to help bolster that down payment and pay for closing costs. And then of course seller credits. If the seller decides they want to pay a little bit of closing costs, that can also help drive down the amount of cash that you need out of your own account. So yeah, you got a lot of options out there.
Thank you so much.
You bet.
Well, Roger's busted 5 mortgage myths.
Took care of them.
If you'd like to get a mortgage quote from Roger, just follow my website here, and there's a link to Roger's website, and you can get them started on getting a mortgage quote. Right,
they can inquire, they can introduce themselves and inquire, just have a discussion. They can actually go in and start the pre-qualification application, so that I'll have that information right on on hand to be able to take a look, and then we have a conversation. We'll try to discuss what their needs are and how to break it down.
Great.
So
well,
yeah, be glad to.
Much.
Yeah,
thank you.
My pleasure.